Bloomberg Audio Studios. Podcasts, radio, news.
Joining us now, Mike Wilson with Morgan Stanley with his exceptionally intelligent views on the market. He has not been a raging bull. He's been someone who has participated, but done it with a bit of angst and caution as well. There's the Mike Wilson word, Mike Wilson, nimble. If I'm nimble after 5 days down in a row or whatever it is, how nimble am I into Monday? What do I do now to reposition with confidence?
Well, good morning, Tom. Look, I think, and Happy New Year. I think what you said earlier is listening to you chatting about, do I get in now? What do I do? And that's really not ever the right strategy. The right strategy is to have something committed at all times and be, balanced in your portfolio so that you can ride out, turbulent times when they arrive. And look, we've had a little bit of a bad stretch here since the beginning of December, which doesn't really surprise me, given the run that we had, post-election and just a lot of euphoria. So we're having a bit of correction here. I do think the first half of 2025 will probably be a bit more challenging. And then the second half sets up pretty well, assuming that, forecasts around the economy and earnings come through. Everybody knows the market's expensive. Everybody knows that, we've had and sentiment's crazy right now. And that's just part of the game. I mean, you have to deal with that. And that's why you have diversification in your portfolio.
You look at factors. I think of Liz Ann Saunders over at Schwab as well. Which is the factor now with the closest Mike Wilson study?
Well, we look at all of them, obviously, and I would say what's been the factor that's been most in favor has been quality and momentum. And then recently, both of those came off a bit because that's where people were positioned. Okay, that doesn't mean that those aren't still the places to be. It just means that we're having a bit of a pullback in here. And I think going into 2025, there are some areas that got probably a little bit overdone. Some of the growth areas. That factor in particular, probably people are paying up for that too much. I think some of the size factors, people rotated probably a little bit too much into the small cap area, and they're giving some of that back now too. So that's just one sort of arrow in our quiver, and but it's definitely something we watch closely.
Hey, Mike, I'm reading your most recent note about the breadth of the market. It gets me to thinking here. I got the S&P 500 in 2024 is up like 24%, yet the equal weighted S&P up only 10 or 11%. What does that tell you? I mean, and how concerning is that for you?
Well, I mean, it's not really. Remember, breadth is a symptom, of what's going on, not the cause. Okay. And so the weaker breadth tells us that certain things are going, and this is something we think we've gotten very right over the last several years, which is that it's a very government heavy economy, right? So if you actually look at the private economy has been sort of languishing, whether it's manufacturing or housing, some of the consumer goods areas. I mean, they're actually in a recession. They've been in a recession for 2 years. And the government, heavy-handed, form of government, whether it be fiscal or monetary policy, has kind of kept things buoyed. And the market has figured that out. And of course, you have things like AI, maybe weight loss drugs, certain themes that are very specific to certain areas. And those areas have carried the day. Okay, so I think the weak breadth is symptomatic of this very unbalanced economy that we're dealing with. Now, one thing to point out, however, is the second half, really since September, the breadth improved tremendously. And actually, the breadth in 2024 was still way better than it was in 2023. So it's not all bad, but it is like I said, it's a symptom of what I think is a very unbalanced kind of recovery that is ongoing.
So I guess as we think about 2025, Mike, I think a lot of folks are saying this really, if there's going to be any performance in 2025, it really has to be driven by earnings growth, because maybe the Fed's going to cut a couple of times, but I'm not sure how much more than that. Are you concerned that the earnings leg of this story is maybe a little ahead of itself?
Well, I mean, look, the markets they get ahead of that, right? So the markets, multiples, rallied because it anticipated an earnings recovery. Of course, this summer we had some turbulence, and then the fall things picked up again. We think most of the rally in the second half was driven by sort of liquidity factors and just sentiment picking up around the election. just getting that behind us, a definitive outcome, et cetera. And so now we're a little bit ahead of ourselves. So multiples probably have to consolidate a bit. The key for this year is, are we going to get a broadening out in the earnings participation? Okay, so earnings have been pretty lousy for most companies over the last 2 years for the reasons I mentioned earlier. Okay, interest rates are too high for most businesses. Government is crowding out a lot of smaller businesses and even larger businesses to some extent. The global economy is still kind of stuck in the mud. So a lot of multinationals are not doing well. So the key for next year is, can we see a broadening out of that earnings recovery? We think we can. And that's our job. Our job is to figure out where is that earnings going to pick up. Financials is one area where we've gotten more constructive recently because of the earnings story specifically.
Mike Wilson with us with Morgan Stanley. If I need breadth to go higher, Mike Wilson, is healthcare so dominant that if healthcare doesn't perform, I don't see an intelligent gain in the market?
No, I don't think so, Tom. I mean, healthcare has been languishing for a while. It's been, there's been some big home run winners, and as I mentioned earlier, some of the weight loss drug winners, et cetera. But healthcare has been languishing for the better part of a year and a half on a relative basis, and the market's been fine. So I don't think it's necessary condition. It would be helpful. We'd like to see it happen. I think for healthcare specifically, with the appointment of Bobby Kennedy, well, let's see how that goes. I mean, I think that the sector is probably going to remain under pressure until that confirmation hearing.
Interesting.
And then I think from there we might get a bit of a bounce.
Yeah. Mike Wilson, tell me about the necessary condition for breadth to work. What is the single item that you're studying with your team to say we have good breadth?
It's what you said earlier, Tom. We need better breadth of earnings revisions. I mean, this has been a theme of ours for the last 2 years. One of the reasons why we weren't maybe as enthusiastic as others in terms of the rally we've had is because we thought it would be narrow. In fact, our forecast suggested that the earnings recovery itself was driven by heavy cost cutting in the Mag 7. And then, of course, they had AI, which helped a handful of companies. You had a few other themes that were driving growth. You had government support for infrastructure spend, things along those lines. And so it was very narrow. So in order for the market breadth, the price breadth to get better, you need earnings breadth to get better. I don't think it's that complicated. And that's what we think should happen in 2025, assuming, once again, that we don't get some policy changes that are maybe negative for the market in the near term. And that's really our concern in the short term, is that we think some of the policy changes are probably going to be more negative in the beginning and then more positive in the second half.
Hey, Mike, as we all know, the S&P 500 over each of the last 2 years has grown north of 20%. I'm not sure earnings have grown to that extent. What's the valuation call right here as you think about the market here, Mike?
It's expensive. I mean, that's not a great insight. I mean, this is probably the single biggest miss by, I think, everybody in the last 12 months. I don't recall anyone saying they thought we would trade to 23 times earnings, but of course everybody rode the wave, including us, and you're happy to take it. And so now you're sitting here 23 times earnings, and you're like, well, now we need to see the earnings actually surprise to the upside. And you're exactly correct on the fact that earnings have not been the main driver of the returns. The main driver of the returns has been equity valuations.
Right.
And there's been some specific names that have done a great job in earnings, and those are unique. But overall, this has been probably one of the biggest multiple expansions we've ever seen, coming out of a recession.
Okay, so what does that do with cash for Mike Wilson? For Lisa Shallot in Morgan Stanley Wealth Management, is cash your friend right now?
Well, I think short duration fixed income in general has been our friend for the last several years. Being underweight, duration, whether that's 2 years or 1 year or cash, they're all doing the same thing for your portfolio, Tom. They're giving you a nice 4 to 5% return with very low risk. And so that's a great place to have some of your money. Once again, not all of your money. We're probably 5 to 7% kind of in that cash rate region, which is 2 years and in. And that's fine. That's a good place to be when you're getting compensated. I mean, just recall 2 years ago, you were getting zero on that cash. Now, that's a bad deal. But today you're getting actually a pretty positive return. And there's a place in every portfolio for something like that. Just ask Warren Buffett.
Hey, Mike, it seems like the market's discounting 2 Fed rate cuts this year. Is the market okay with that? Or do you think the market needs to see a little bit more? Or do you think the market is fairly discounting 2 rate cuts?
Well, first of all, let me just make an opening statement about that. I mean, if there's one thing that the markets have been more wrong about than Fed cuts over the last 4 years, I'd like to know what it is. So, I mean, this has been probably the single biggest whipsaw, both on the upside and the downside, that the markets have gotten wrong. So I think looking at the bond market right now, what they're pricing in is a waste of time because they don't know. The Fed doesn't even know. What I would say, however, one of the reasons why the breadth has deteriorated, I talked about that as a symptom. The cause of the breadth deterioration, one of them is the fact that rates have gone up at the back end almost 100 basis points since the Fed has cut 100 basis points. Think about that. That means the term premium has really gone up sharply. And that's been something we've been focused on. When the term premium kind of gets up into this range, you actually now are at risk of having an equity valuation correction. So we think that's probably the main reason why the breadth has deteriorated here recently, more so than earnings. And I think, 2 cuts, sure, why not? Could we get 0 cuts this year? Possibly. Could we get 4 or 5 cuts? Maybe. It just depends on how things play out. But I think right now, 2 cuts is kind of the best guess. And the bond market is probably a little bit suspicious about that based on how the back end's trading.
Mike Wilson, thank you so much. Chief U.S. Equity Strategist, Morgan Stanley, generous to be with us.